By the summer of 2026, technology valuations reached record highs on a shared assumption that demand for artificial intelligence would never hit a ceiling. The market had normalized a state of constant expansion. Nvidia CEO Jensen Huang led a company worth more than $5 trillion, a figure that exceeded the value of most of the world's individual stock markets combined. Alphabet's second quarter earnings report seemed to justify that scale. Revenue hit $119.8 billion. Google Cloud surged by over 80% to nearly $25 billion. The company was generating $39 billion in cash from its core operations. But when the market opened the following morning, investors didn't buy the results. They sold. Alphabet stock plunged 7%, erasing $300 billion in value. Tesla lost $200 billion. Amazon dropped $120 billion. The sell-off was so rapid, it dragged down companies that hadn't even reported their earnings yet. By the time the bell rang, over $600 billion in market value had vanished. It was a massive contraction that happened on the exact day big tech delivered its best operational results in history. To find the reason for that panic, we have to look past the top-line profits and check a metric called free cash flow. Imagine a company called SolarCharge. They sell solar charging hubs for electric vehicles. In a record year, the company brings in $500 million in cash from its sales. But the founder is worried about competitors. To secure the market, he decides to build 400 new charging stations in a single year, which cost the company $700 million in construction and equipment. If you look at the bank account at the end of that year, the math changes. Take the $500 million in profit, subtract the $700 million spent on construction, and you're left with a negative $200 million balance. SolarCharge is selling more than ever, but its physical expansion is consuming its cash faster than its operations can generate it. To keep building, it has to start borrowing. This is exactly what Wall Street spotted in Alphabet's earnings. Alphabet brought in $39.1 billion in operating cash, but spent $44.9 billion on capital projects, mostly AI data centers. Subtracting that spending leaves a negative free cash flow of $5.9 billion. For the first time since its 2004 IPO, Alphabet wasn't generating enough cash to cover its expansion. To bridge that gap, Alphabet's long-term debt doubled in just 6 months, reaching over $98 billion. Investors saw that the AI boom was no longer paying for itself. One of the most profitable monopolies in history was now being funded by a mountain of newly issued debt. Alphabet isn't alone. The major tech giants will spend a combined $800 billion on capital projects in 2026. That's an 8-fold increase. In 2020, this group spent $90 billion. By 2026, this spending level has no parallel in private sector history. Amazon's individual capital budget alone is now larger than the annual capital spending of the entire U.S. energy and utility sectors combined. This started as a software race, but it has turned into the most expensive physical construction war since the early 20th century. That money is being funneled into data centers, massive, specialized industrial warehouses designed to run the chips that power generative AI. A single building can house 100,000 Nvidia chips. At roughly $40,000 each, the processors alone are worth $4 billion. Once you add liquid cooling, power grids, and land, a single data center can cost up to $25 billion to build. Microsoft and Alphabet claim they have no choice but to spend this money. They are currently facing massive order backlogs from customers, backlogs worth tens of billions of dollars that they cannot fulfill until these buildings are finished. The central question for the economy is whether the profits from AI software will eventually grow fast enough to pay off the crushing debt being used to build the hardware today. On July 23, 2026, the technology sector lost $600 billion in market value in a single trading session. The crash was paradoxical. Alphabet and its peers had just reported record-breaking revenue and massive growth in their cloud divisions. Under normal conditions, these results would have triggered a rally. Instead, the market reacted with a level of panic usually reserved for total operational failure. To understand why investors suddenly turned on the world's most profitable companies, we have to look at a mechanism called the circular financing economy. In circular financing, a manufacturer co-signs an unprofitable startup's loan to buy their own products. They book revenue but hold the risk. Scaled up, Nvidia guarantees a $600 billion debt and financing package for OpenAI, dwarfing Nvidia's $216 billion revenue, while OpenAI burns $38 billion. The revenue numbers driving tech valuations were not independent signals of market demand. Instead, they were highly leveraged, interconnected bets that left the entire ecosystem vulnerable to a single massive credit default. This build-out required hundreds of billions of dollars in physical materials. If these companies weren't using their own operating cash to fund it, and they weren't reporting massive new liabilities on their public balance sheets, where was the debt hiding? An investigation by the financial publication Nikkei found that the Big Five tech giants had accumulated $1.65 trillion in hidden debt over just 4 years. These are long-term lease and financing obligations that accounting rules allow companies to keep off their primary balance sheets. To manage liabilities of this size, tech companies use independent shell entities. When Meta began building a massive data center campus, it didn't borrow the money directly. Instead, a separate entity called Beignet Investor LLC was created. Meta took a 20% stake, the maximum threshold allowed to keep the shell company's financials off Meta's own reports. Beignet Investor LLC then went to the bond market and borrowed over $27 billion to build the facility. Meta simply signed a long-term lease to be the sole tenant, paying monthly rent to cover the bond payments. The debt stays with the shell company, leaving Meta's public balance sheet looking clean to shareholders. But while equity investors looked at top-line revenue, the bond insurance market saw the hidden risk. On the day Nvidia's financing talks leaked, the price of credit default swaps, insurance against a company defaulting on its debt, recorded its largest single-day jump in history. The cash-rich, asset-light monopoly model of the last decade has been replaced by a cycle of heavy infrastructure spending and trillion-dollar liabilities. By using accounting loopholes to keep this build-out off their balance sheets, these companies function as asset-heavy utilities, carrying the risks of high-growth startups. A second accounting shift helped inflate tech profits on paper, spotted by investor Michael Burry, who correctly identified the 2008 housing collapse. This diagram shows how hardware costs are managed in corporate accounting. When a company buys $30 billion in servers, they don't record the full cost at once. They spread it out over the years the equipment is expected to remain useful. In this case, that means recording a $10 billion expense every year for 3 years. Burry noticed that major tech firms quietly changed these lifespan assumptions from 3 years to 6. By simply telling their accountants the machines would last longer, they cut their annual recorded expenses in half. That extra $5 billion in unspent cash was then reported to the market as profit in their quarterly earnings. The flaw in this logic is physical. AI hardware does not stay useful for 6 years. Each generation of semiconductors is dramatically outperformed by the next in a matter of months, making existing chips economically obsolete in 2 or 3 years. Record-breaking profits were often the result of changing a single number on a spreadsheet, an accounting choice that ignored the rapid decay of the hardware the companies were stockpiling. These financial maneuvers worked as long as external customers kept paying for AI services, but in the summer of 2026, the enterprises at the end of the chain stopped funding the loop. Palantir CEO Alex Karp delivered a blunt assessment on live television, stating that American business leaders were livid. He reported that enterprises were paying astronomical sums for AI processing tokens that were failing to generate measurable business value for their companies. To stop the financial drain, businesses began moving away from expensive frontier AI models in favor of cheaper, efficient alternatives. The assumption that demand would rise indefinitely, justifying the mountain of data center debt, collapsed overnight. Without a way to pay back the $600 billion in data center debt, the ecosystem's self-funding mechanism shattered. This pattern has repeated for centuries. In 1846, British investors poured their fortunes into a railway mania, convinced that rail travel would expand at an exponential rate forever. The same cycle occurred in the late 1990s, when telecommunications firms spent hundreds of billions on fiber optic cables. In both cases, the first wave of companies built capacity for a level of demand that wouldn't arrive for another decade, leaving them unable to service their debt. Cuban warned that the AI build-out would face the same physical reckoning. Without the revenue to support them or the electricity to power them, he suggested these multi-billion-dollar data centers would eventually be repurposed as pickleball courts. Artificial intelligence is a real technology that will eventually change the world, just as the internet and the railways did. The 2026 crash marked the moment the AI build-out collided with the mathematical laws of debt and depreciation. Even the most revolutionary technology eventually faces the same requirement as any other business. It must generate enough cash to pay for the machines that run it.